We need to talk about Meta stock right now because this isn't just another dip. Since the start of the year, Meta has wiped out about $300 billion in market cap, and it's now roughly down 30% from its 52-week high. And that's one of the fastest sentiment shifts we've seen in a Mag 7 stock in years. The internet is currently split into two camps. One side is telling us it's a generational buying opportunity, and the other side is acting like this is the end of Meta forever. So today we're going to cut through all of the fluff. We're going to run Meta through a structured 6-step audit looking at what actually matters, and by the end of this video, we'll know exactly where this stock stands and whether this drop is an opportunity or a warning sign. And trust me, the score tells a very different story than the headlines. So let's get into it, but first, as always, this isn't financial advice, it's just financial education, and if you get any value, please consider subscribing to the channel. I really do appreciate it. And before we score anything, we first need to understand the world that this stock is operating in right now. Meta is not trading in a normal environment right now. This is one of the most complex macro setups we've seen in years, and it's coming from three directions at once. First, the Iran conflict. Markets just sold off hard yesterday as war risks started getting priced in, and oil is rising. Second is interest rates. At the start of the year, everyone expected cuts. Now that's falling apart, because if inflation stays elevated, the Fed can't ease, and when rates stay higher for longer, high multiple stocks get repriced, and that hits Meta directly. Third, the AI trade is starting to show signs of cracking. Several Magnificent Seven names have sold off hard. So this is the key point. This is not only a Meta problem. This is a full market de-risking event. War, inflation, and AI skepticism all hitting at once. And that's the ring that Meta is fighting in right now. So let's get specific, because on top of all of that, Meta has its own issues. In the last 90 days, 4 things have changed, and you need to understand all of them before we start the scoring. First, the lawsuits. Meta is dealing with a $375 million verdict, but the bigger issue isn't just the size of the fine, it's what could this mean for the legal shield that has protected these platforms for years. The real question is whether courts keep allowing these kinds of claims to keep moving forward. Second is AI spending. Meta is going all in on AI. We're talking up to $169 billion in expenses for 2026, plus massive infrastructure builds. Third is layoffs. Around 700 employees have been cut recently as the company restructures around AI. So that tells us exactly where the priority is and what's being sacrificed. So that's the setup. Now we stop reacting and we start scoring. I want to show you exactly how I'm going to be doing the quick audit today inside the computer. So let's go in there now. So here we are inside Chart Equity, and I'm going to pull up Meta's chart here in the Stock Analyzer tool, and we will pull up first the revenue category. And this would be the first category that we score in our stock audit. And just for the record, if you want access, just come in here, click on the dashboard, and there is a link for the stock audit PDF and course that you can get access to for free. So here's what we're looking at for this category. We are actually going to be looking at revenue, and we're going to look at the annual revenue here first. And you can see that the company went from about $117 billion in 2021 to $201 billion in 2025. That's a near double in 4 years at a company operating at massive scale. So for context, most mature companies are happy with a 5 to 8% annual growth, and Meta is doing 22%. Q4, let's look at that. Alone, it hit $59.89 billion, up 24% year over year. Now let's talk about the advertising side of the business, since this is basically where all of Meta's revenue is coming from. And 2 things drive that number: how many ads they show and what advertisers are willing to pay per ad. And in Q4, impressions, which are basically ad views, were up 18% according to their latest report, and the price per ad was up 6%. Both moving in the right direction at the exact same time is a great sign. But here's where I want to talk about a couple of bear points for Meta in terms of revenue. If Meta is hitting the limit on how many ads it can show people without annoying them, and advertisers aren't willing to pay more per ad, then the only way to keep this revenue up or growing is through user growth. And let's be honest, with a company that has nearly 3.6 billion daily users, that is going to be a tough path. Now, there's also the regulatory headwind building in Europe. Starting January 26th, Meta now has to let European users choose a less personalized ad experience, which will likely result in reduced margins. Now, these are forward risks, not the current damage, and this framework is currently based on the current market and where we're at now. And we do consider some of the forward risks. If you read the PDF, you can see we do mention that. But currently the revenue now is clean. It's consistent, it's growing fast. So for now, we're going with a revenue score 5 out of 5 on their revenue here. As you can see, it's just a clean up and to the right. So let's move on to category 2, profitability. Profitability is easy to see inside the margins tab here. We'll start there. And you can see here, the question is simple. How much of the money Meta makes does it actually keep? And in the income statement, operating income for the full year came in over $83 billion. The operating income ratio was 0.41%. So that means after paying for salaries, servers, data centers, everything basically, Meta kept 41 cents of every dollar it brought in. Now we look at the net margin line, and on the chart in 2022, we were at around 19.9%. And today it's over 30%. So that 2022 dip was largely the metaverse. And Zuckerberg bet big and the market hated it basically. So Reality Labs burned through billions of dollars, but that capital appetite didn't go away. It just changed directions recently. The same money is now pointed at AI. And personally, I'd rather see them spend this money on AI than on whatever the metaverse was supposed to be. And this time, the early signs are actually showing up in the revenue numbers with the AI investments. So let's look at the number that's been a bit confusing for some. The net income, which dropped from 62.4 billion roughly in 2024 to 60.5 billion in 2025. And that margin line, that was a one-time tax event in Q3, roughly $16 billion non-cash charge from a new US tax law. So that distorted the whole annual number. So if you strip that out, the earnings picture is fine. Now, if we look quickly at the free cash flow, the chart shows 46.1 billion for 2025, down from 54 billion. That drop matters, but the reason behind it matters more. Meta nearly doubled its capital expenditure in 2025 to $72 billion building AI infrastructure. So that capex comes straight out of free cash flow. With $115 to $135 billion in planned capex for 2026, free cash flow will most likely go down again before it recovers. So keep that in mind. So for profitability, I'm scoring it a 4 out of 5. We have strong margins. We have expansion since 2022. And the net income dip is a tax story, not a business story. So it's not a 5. Because costs grew roughly 40% in Q4. And the capex ramp is already putting visible pressure on the free cash flow. So let's move to category 3, the balance sheet safety. Total assets are 366 billion against liabilities of 148 billion. And that is a very strong buffer here. We can see assets versus liabilities also right here. You can see the numbers here. So debt has been going up with Meta. Meta did issue that debt to fund its infrastructure build out without burning through its cash reserves. The debt versus cash flow picture to me isn't alarming because of their free cash flow, but the direction here does matter. Debt is increasing rapidly, and the capex commitment for 2026 suggests that trend continues. So that could be why we're seeing some weakness here in 2026. So here I'm giving the balance sheet score a 4 out of 5. Assets do comfortably cover liabilities. Liquidity is strong. The debt is manageable relative to their earnings power. So I'm not alarmed by the debt here currently, and that's the reason why it's not a 5. Debt did double in a year, and the spending cycle isn't over yet. So moving on to category 4. This category you can't really fully read off a chart. It's the competitive advantage. So what does Meta actually sell? They sell attention. 3.58 billion daily active people. No competitor has meaningfully disrupted the core user base in 15 years. TikTok did come close on engagement, but Meta responded by building their Reels and integrating short video across the family of apps. Meta is also working on building AI agents and smart glasses, so this is going to give them more competitive durability, which could grow well beyond the current product suite of ads mainly. So I'm giving them a competitive advantage score here, 4 out of 5. Again, clear market leadership, high moat. They've clearly shown that they can respond to competitive threats. And the only question here is the legal architecture uncertainty around the Section 230 and the next generation user acquisition question, which prevent this from being a 5. Okay, so now let's go to valuation, back to chart equity, and we're going to go look at this information here. At the prices in the low to mid 500s, which is where Meta has been trading this week, the trailing PE is in the 24.36 range, and this comes from Yahoo Finance. Forward PE currently is 15.95, 16 roughly, we'll say. So Meta's historical average PE is around 23 times, and right now it's trading at a discount to its own history, and the forward PE is even much more of a discount. So a company growing revenue at over 20% annually, generating roughly 40% operating margins with 3.6 billion daily active users, to me is priced fairly cheap at these current valuations, especially the forward PE. So for context here, if you look, the high side of the analyst ratings is $1,144. So that represents a near double from where we're at right now, or more actually. And so let me be honest though about the counter argument. The $115 to $135 billion capex plan for 2026 is going to compress free cash flow. So if you use free cash flow yield as your valuation anchor rather than earnings, the picture looks less compelling in the near future. But here's what our framework says. You're scoring alignment between price and realistic growth. At its current forward PE, the price actually looks modestly conservative relative to the growth. So I'm scoring the valuation score here 4 out of 5. Valuation does appear conservative relative growth rate, but the forward capex uncertainty again is the reason that this isn't a 5. And free cash flow in 2026 will be under more pressure than the earnings line might suggest here. So last step here is capital allocation, and Meta returned over $31 billion to shareholders in 2025 and $26.3 billion in buybacks and $5.3 billion in dividends. If we look at the shares outstanding, you can see this is nice to see when we see these drops in the shares outstanding. So I'm scoring them 3 out of 5 on this here because share buybacks were paused in Q4. The company took on $30 billion in debt. Free cash flow is going to compress, and these are mixed signals on capital discipline. Not super alarming, but not exceptional. So that's why they get a 3 out of 5 here. And so let's add that up. We have revenue 5, profitability 4, balance sheet 4, competitive advantage 4, valuation versus growth a 4, and capital allocation 3. Total 24 out of 30. And that's right on the edge of what we call a strong business. It's not perfect, but the key point is nothing here says the company is broken. What it says is the company is solid. But it's moving through a period where the risks are getting all the attention. So here's the way I see this. I'm buying, but I'm not going all in at once. I'm building into it because this is exactly when I want exposure. When sentiment is weak, when headlines are heavy, and when good companies get dragged down with everything else. So this isn't hype, it's not guessing, it's just a structured buy on a business that's still intact, at a price that the market is giving us because people are uncomfortable. And if you're serious about investing, that's usually where the opportunity shows up. And this is exactly why we built this quick system. So if you want this process you can actually use, not just for Meta, but for anything you look at, that's what this channel is all about. So please subscribe if that's what's missing in your portfolio. And also, if you're already inside chart equity, go run this for yourself. There's much more detail in the free course that we're offering as well. And you can look at even more numbers. See if you land at the same place or if you don't. Because at the end of the day, the goal is simple. We want to figure out quickly if a company is even worth our time before it even earns a place in our portfolio. Thanks for watching, and we'll see you in the next video.